Okay, we are going one step ahead. Okay, we are talking about what are the how we are going to measure valuation and disclosure of assets. Which type of assets with respect to the short-term assets. You are you are going to be basically you are going in detail about each and every concept. Okay, now it starts. Okay, now when you do the things, okay, this is the now measurement valuation. Now we will do short term. Okay, when we do the things, what this study unit discuss two current assets, which are the things we are discussing: account receivables and inventory. Is that account in detail accounting for account receivables, transactions related to account receivables, including the timing of recognition, how we have to treat the credit losses, and how what is the types of factoring. Any idea about factoring?
Yeah.
Okay.
Factory. No. Factory that depend on the inventory.
No, on the credit sales, receivables.
Okay.
On the receivables. Very interesting thing, okay? And most of the people will do that, okay? Most of the people will do that. Okay, types of factoring, okay? We will cover this 1, 2, 3. With respect to the inventory, items include in the counts of inventory, what is the cost flow assumptions methods, okay? Calculation of cost of goods sold ending inventory, different cost flow assumption methods. What are the effects of errors? Lower or cost or market value, lower of cost or market value, or lower of cost of net realizable value. These are the two different ways, is it? Either you have to take the lower of the cost or market value, or lower of the cost or net realizable value. This we will cover. Basically two things. What we are going to cover here, we are going to cover it in consideration the accounts receivables and inventory in detail. Detail means you can put it as specific as possible. Now, when we do that, I know, I am not saying that you don't know, you know the things, but even I'm just refreshing it up. Is the trade receivables amount owed to the entity by the customers with from the credit sales in the ordinary course of business. Is that on the customer there will be trade terms and conditions will be there, 30 days, 60 days and 90 days. The recording of receivable which often coincide with revenue recognition. Is that revenue will be there, sales will be there, automatically you will have a credit sales inconsistent with the accrual method. When it happens, is that which method we are taking into consideration? We are taking into consideration the accrual method of accounting. Okay, now what will happen when you do the thing? In our cases, we have done less provision for losses, provision for bad and doubtful debts. Okay, here also what will happen? What will happen when it is a provision for bad and doubtful debts? What will happen? It will have effect on the asset side as well as it will have effect on the liability side also. Okay, provisions we will show it on the liability, and in the asset side we reduce the receivables. Is it? In that case, there is one thing called as a contra. You have any idea about this?
Yes. An account appear in two places.
Yes, is that an account appear in two places. The allowances for credit losses is a contra asset that reduces. It will reduce not only the account receivables on the entity side. The account is that it reduces the account receivables on the entity side, as well as on the liability side. It will show in at a provision for doubtful debts. Okay. Now, this account is used to keep track of, it is only an estimate. We are not talking about it. It is a provision. It is an estimated amount of uncollectible receivables. Is it? Where we are talking about, when you are talking about the unconservative, we use the word what? We will be very, very conservative approach. Okay, conservative. We use the word called as a prudence concept. We will never, will not overestimate or not, we will underestimate. We'll try to make a correct projections. This account is used to keep track of management estimate for the amount of receivables that the entity estimates it will not be able to collect. Is that non-recoverable? Okay, non-recoverable. Now, what is that? See, definitely, is that you are talking about what is the usually what we'll do? We will have the receivables, okay? We'll have the receivables of 8,000. We will say that, is that provision for doubtful debts. Is it provision for doubtful debts? Provision for doubtful debts, we will say that it is going to be 5%. If it is going to be 5%, how much you will say it is going to be 8,000 for? How much you will show? You will show receivables as 7,000. This is only a provision, estimated amount. Is it? This is only an estimated amount. Credit loss expense, when what we'll do, we'll show it in the from the profit and loss account also, we'll deduct. Is that from the, we'll show it as a from the profit and loss account. Credit loss expenses is the income statement account used to keep track of expenses related to credit losses. Is that what we'll do? We are deducting. Is that we are deducting it from where? We are deducting it from the income statement. Is that we are deducting it as a income statement, as what? As a provisions. Make it very clearly. Wherever there is a doubt, you put it on paper and understand. The most important thing is how it is affecting the financial statement. We are not concerned only about income statement. We are not concerned only about the balance sheet. We should concern about income statement, balance sheet, cash flow statement, and statement of changes in equity. All the 4 different perspectives you should be very clear in understanding. Okay, that's what it is. What is the how you are going to show in the balance sheet presentation? Receivables should be separated as a current or non-current portion. Definitely, most of the time it will be a current assets only. Most of the entity accounts receivables are classified as a current asset because they are expected to collect within 1 year of the normal operating cycle. I will not say within 1 year. Within 1 year is maximum, it is going to be 90 days. Current account receivables are reported in the balance sheet as a net realizable value. Net realizable value is nothing but receivables minus provision. Net of the allowances for credit losses, allowance for sales returns and building adjustment. Whatever the sales returns are there, whatever the adjustments are there, settlement is there, whatever is there, it's applicable. Non-current receivables are measured at net present value of future cash flow. Maybe I will tell you very clearly, this is the first time you are going to cover this. Non-current receivables. What are the non-current receivables? It is more than 1 year. It is more than 1 year. When it is for more than 1 year, we are using it. It has to be measured at what? A net present value of the future cash flows. You have what are the non-current receivables? You have given loans. Okay, you have given loans to the customer. Then it will be a non-current receivable. You have to calculate as based on the net present value of future cash flows. I am putting 1 star here. Okay, just keep it in mind when you are revising it. It is a new thing. Okay, now what is the rule of a gap? This is most important. Is that the allowance method required under general accepted accounting principle? The allowance method attempts to match credit loss expenses with related revenue. This method is required under GAAP. You have to match what is the expenses with the related revenue. How much you are going to see. assume you are talking in terms of 2025, okay? 2025, you have the revenue. How much is the revenue? You have the revenue of 25,000. Then automatically, if you are having a credit loss expenses, how much you are going to have a credit loss expenses from this? Okay, under the gap. Okay, we have to match it point to point. As specific accounts receivables are written out, they are charged to the allowance account. What we'll do, we'll say the provision for allowances, provision for loss allowances, provision for bad and debtful debt, allowances for bad and doubtful debts. Okay. Now, as specific accounts receivables are written out, they are charged to the allowance account. Write-offs do not affect the carrying amount of net accounts receivables balance. Write-off is, see, what is the net account receivables? We have mentioned here very clearly. What is the net accounts receivables? It is the net. Is that we are talking in terms of the allowances for sales returns, billing adjustments, anything is there. Okay, anything that is related. Write-offs do not affect the carrying amount. It will not affect the net account receivable because reduction of gross account receivables and the allowances are the same.
Repeat this again, please.
Yeah. Write-off, okay? Write-off, see what write-off do not affect the carrying amount, net receivable. See what is the write-off? You have the receivables, okay? You have the receivables. How much is the receivables? You have the receivables of 2,200, okay? You have write-off, you have written it off, okay? You have write-off the receivable. Write-off means it is bad, not recoverable.
Not recoverable, yes.
Is it not recoverable? Not recoverable is 100. Means what is the amount is there? It is going to be 2,100. This is what? This is the net receivable balance.
Oh, okay.
Is it will not affect anything. Is it not affect anything? Is that because what gross account receivables and receivables will be the same? Means when we have given write off, it will not be part of the thing. Now what will say, whatever this is the net receivables, but subsequently what will happen? It will become a gross receivables. Okay, this much you are going to receive it. Is that this much you are going to receive after writing off the any bad and doubtful. Once it is right, we are what we are going. We have already treated it as a loss.
Oh, yes.
Yeah, that is the reason. That's the reason. The write-off of a particular account has no effect on expenses. Once it is written off, then we are closing it. Okay, we are closing it. There is no point of carrying forward it for the next phase. Is it? We are thinking that it will not be recovered and it will be treated as a loss. Is it okay?
Yes.
See the thing, what they say. In the balance sheet, the carrying amount of account receivables is reported as the net amount. What is the net amount? Accounts receivables is there. Accounts for credit losses is there. Fine. Is it? I will put like this. It is 10,000. I am taking a small example to make you understand. How much is there? 100 is the losses. Amount receivable is how much? 9,900. Under the allowance method, under the allowance method, is it? And the two approaches to calculating amount charged to credit loss expenses are the income statement approach and the balance sheet approach. The two different ways are there, methods, approach are there. You can adopt any one. Okay, if you are taking the allowances, okay, allowances. Either you follow the income approach or you income statement approach or you follow the balance sheet approach. These are the things that may will really matters us. Okay, these are the things. We should be very clear. Is it right? Wherever wherever I am putting stars, okay, that makes the that will be more focused on that. Now, income statement. When you are doing the income statement approach, what is the way? If we are taking the income statement, it is based on what? It is based on the percentage of sales. Simple one. If it is an income statement, percentage of sales. If we are taking the balance sheet approach, it is on percentage of receivables. Okay, it is on the percentage of receivables. Okay, this is where under the as simple as that. Under the income statement, the entity estimate the periodic loss expense as a percentage of sales on credit. The ending balance of the allowance for credit losses is determined after all the activity of allowance account is recorded during the period. Now, what is the income approach? See the thing. The following unadjusted accounts are: you have the cash, you have the receivables, you have the account allowances for credit losses, and you have the sales on credit. Is it? Now, based on its experience, Midberg expect credit losses to average how much? 2% of the credit sales. Thus, they estimated the credit loss 2%. How much is there of the credit sales is going to be 10,000. Is it 500 into 2, 10,000. How you have to make the adjustment. Now, when you are making the allowances, what will happen? Your assets will also decreases. Your liabilities will increase and your profits will decrease. Okay, profits will decrease. Your assets will also decreases. Your profits will also decreases. Since allowances for credit losses is a contra asset, this 10,000 entry reduces total assets but increases the balance in the contra asset. Is that what were previously? How much is the allowances for credit losses? Previously, allowances for credit losses is 2,000. Okay. Now, what they say, the allowance is expected to average 2% of the credit losses. Is that current year? How much is the current year? Current year sales is how much? 500,000. 500,000 times 2. Now, what happens? Previously, how much is there? Previously, it is 2,000 plus current year is going to be how much? Current year is 10,000. Total allowances for credit losses is going to be 12,000. Is that all? Now you can see previously account receivables are how much? Previously, see, now if you add, okay, if you take into consideration, this is the pre-accounts receivables, okay, this is the account receivable. In this account receivables, how much is the allowance? Allowance is 2,000. In the sales, okay, how much is the allowance? Allowance is the 10,000. Total allowance is going to be how much? 12,000. Is it right? Means they are saying that they expect the credit losses to average. What is the expected of the 2% of the credit sales? 2% of the credit sales means on this there is expectation of 2%. Means it comes to how much? It comes to 10,000.
1,000. Yes.
The previous 2,000 plus current year sales. On this current year sales, how much they are expecting? They are expecting 2,000. Are you clear about this? Total credit losses. As the total credit losses is going to be how much? 10% plus 2%. It comes to 12,000. Are you clear about this?
Yeah.
Okay. This is, we are talking about account receivables. How it is going to be with respect to the receivables? Okay, how it with respect to the balance sheet approach of percentage. This is percentage of receivables. This is not percentage of sales. This is percentage of receivables. Under this approach, what they say, the ending balance of the credit losses, the ending balance. is a percentage of the ending balance of receivables. Is that the what is the closing balance? Closing balance of is based on the closing balance of the receivables. Credit loss expenses adjustment to the allowance is the correct ending balance. The closing balance of receivables is the closing balance of the accounts receivables. Okay, using the data, assume that the based on the mid-burst experience, 6% of account receivables is uncollectible. 6% of accounts receivable. How much is the accounts receivables balance is there? 10,000. 100,000. How much is the accounts receivable balance? 100,000. They say message is very clear. The rule is very clear. 6%. They say 6% of the accounts receivables are determined to be uncollectible. Then whatever the accounts receivables is there, 100,000 times 6%. How much is there? 6,000. Balance, because the allowance currently has a balance of 2,000, the following is required. Already how much is the allowance is there? Allowance is how much? Already allowance is how much? Already there is allowances of 2,000. Okay. You need how much? You need 6,000. Okay. You need how much? 6. Already how much you have? You have a 2,000. Now how much you have to make an extra? You have to make an extra of 4,000. Total will be 6,000. Okay. Total will be 3,000. How much additional you have to make? You have to make an additional 4,000. Okay, 4,000. How this 4,000 will come? It comes to 6,000 minus 2,000.
2,000.
Total we are taking 6,000. Okay, total we are taking how much? We are taking 100,000 into 6%. But already we have a closing balance of allowance of 2,000. That 2,000 plus we have to add the current year difference in the amount. Is it okay? Okay. Now I will put like this. Okay. I will put like this. Can I put like this? No, we need lot of information. Okay. We need lot of information. No, you put like this. Is it? How much is the receivables are there? Receivables of 150,000. Okay, receivables are 150,000. How much is the allowance is there? Allowance is there is how much? Allowance is 2,000. Okay, allowance is 2,000. Now, if I ask you to create a 8% allowance, how much you will create? Tell me.
It would be 100. 12,000.
Is it? It will be 12,000. Is it? 12,000. Already how much is there? How much you have? Already we have how much? 2,000.
2,000.
Okay. How much you will get? How much you are creating? New.
10,000.
10,000. Okay. We are creating how much? 10,000. How much it will decrease? It will decrease by 10,000. But if you are showing in the balance sheet, how much will show in the balance sheet? 1,500, 150,000 minus how much will show? Will show 12,000. Are you clear about this?
Allowance. Oops. Minus. Okay.
Is it okay?
Yes.
I will immediately, the moment I will come across something, I will immediately put it into a small example, and I will explain you so that it will be easy for you to have the understanding.
Yes.
Okay, now. An entity rarely experiences single rate of uncollectability of all its. They will not experience. See, you are selling it to different customers. Okay, you are selling it to the A, B, C, D. Different customers will be there. These are all customers. Is it? Some will pay on time. Okay, some will pay on time. Some will take more time. Some will not pay. Okay, pay. Everybody will have a different behavior. Every customer will have a different peer. An entity rarely experiences a single rate of uncollectability on all its accounts. For this reason, entity use balance sheet approach. We will not we are not using the income approach. Which we are going to use? We use the balance sheet approach. Okay? We use the balance sheet approach to estimate the expected credit losses for accounts receivable. Now you can have the thing. There are two methods are there. There is a income method, is the income statement method, percentage on sales. There is a balance sheet approach, percentage on receivables. Most of the people, what they will do, they will see the balance sheet approach based on the receivables. Okay, then we will say what we'll do. We use the word aging schedule. Okay, how many days are there? Older days. We will divide who are there is less than 30 days like this. Okay, who are in more. Okay, what is the range? We also see the balance. We see the total balance also. Is that we Midburg prepares the following aging schedule for its account receivable. We are prepared how much over $10,000. Is it 12,000? Is that 31 to 60 days is 12,000? We will classify. The moment you classify it, it makes things very clear. Who are the people from where we are not recovering the money? Okay, from whom we are not recovering the money? Okay, who are the people? See, we will target. See the thing. Less than 30 days, okay, we will get. There's no issue are there. But there is a more than 90 days. It is more doubtful.
Yes.
It is highly doubtful. Okay, it is less likely. Okay, is less likely doubtful. This is the purpose for which we create the aging schedule. This is the purpose for which we create the aging schedule. Okay, we are not preparing the aging schedule. We should know what is the purpose of preparing the aging schedule. They will ask you a multiple choice question on this. Okay, they will ask you a multiple. Don't expect that they will ask you any calculation. They will not ask you. They will give you a close approach. Is right? They will give a close options. And what is the purpose of preparing the aging schedule? The purpose of preparing the aging schedule is which are highly doubtful. Is that highly doubtful and which are less doubtful? Okay, we have to focus on the highly doubtful. Now, when you do the things, okay, when you do the thing, what they have done, they have said less than. They have taken how much? They have taken the things. Is it right? They have taken the things with respect to what? Yes. How much is the estimated uncollectible? Okay. Then they have, see how much is there less than 30 days. How much is there? 71, 18, 10 and 1. Okay, 71, 10 and 18 and 1. Now, what they say, they have taken what they have calculated. They have calculated, 1 second. They have mentioned, they have to mention how much is estimated uncollectible, 2%, 12%, 15%. have they calculated 1000? Okay, 1000. 1 second. Mm-hmm. 1000. No, from where they got this one, they have not mentioned. From where they from. 2%, 1 second, 2%, 2%. This, okay, they estimated uncollectible. Okay, they have taken the 2% amount, okay, times 2%. It comes to how much? It comes to 1420. Times 12%. It comes to how much? 2160. Is that estimated uncollectible? Okay, they are estimating how much is there. It is 1000 times 2%. How much is the ending allowance? Allowance is going to be how much? 5280. Okay, 5280. This is the ending allowance. Okay, ending allowance. Now, what is the previously they have mentioned? No, nothing is there. That is different. This is different. Okay, that is different. Now, how much is there? Because the alliance currently has a balance of how much? 2000. Where is 2000? Here. Okay, how much is the current balance is there? How much? Current balance is how much? 2000. It is there. Okay, yeah, 2000. Okay, just link it, thread it. Okay, the following entry is required to establish a proper measurement. Is that how much? If already they have a 2000, is it right? Means 5280. Okay, 5280 minus 2000. Is it how much is there? 3800. But in the receivables, how much they are deducting? They are deducting 5280. They are reducing the assets receivables by 3280, and they are also reducing the profits. Okay, they are reducing the shareholders' equity, means from where they are reducing it from the retained earnings. Is that profit and loss account? Don't get confused. Is that as a profit or loss? Okay, they are reducing the profits. How much? They are reducing the profits by 3280. The total amount, how much is there? It is going to be 5280. Are you clear about this? Take the pencil, put your finger and just take the calculator and just put all the things are understandable or not. Make it sure. Is it okay? Fine? Okay, we'll complete this and we'll stop here, okay? Now, reconciliation. The following equation illustrates the reconciliation of the beginning. See, everywhere there is a reconciliation. You have to be very perfect in terms of reconciliation. Okay, I will make you very confident on this. The following equation illustrates the reconciliation. What is the beginning balances and ending balances of the receivables? Okay, beginning balance will be there, credit sales will be added, cash collected on credit sale, whatever the cash collected we will add, and whatever it has been written off during the period we will minus it. You will get the ending accounts receivables. Is it? Ending accounts. This is with respect to what? This is with respect to the accounts receivables. Okay. This is with respect to allowances for credit losses. Beginning losses is there. Any credit loss expense we have to add. Any accounts receivables written off. If we have written off any receivables, is there, as a loss we have to minus anything we have collected A collection of account receivables previously written off. Anything which have been previously written off, now it has been collected, it has to be added. What will have? You will have the ending credit losses. Is that? I assume I will put it numbers. Opening balance is 1000. Okay. Credit loss expenses during the period. Credit loss expenses is 150. Anything which has been written off. Okay. Anything which has been written off 50. Okay. Anything which has been written off previously, now it is collection. Okay. We have previously written off, now it has been collected. How much is there? It will be 100. If you take into consideration 1050, 1100, 1200. Is it okay?